What's going on, everybody? Today is December 2nd, and these are the answers to this week's long or short questions that I post on Twitter. I do this to show you guys that you do not need to rely on indicators or FURUs for alerts, and that you can read price action all by yourself. If you haven't already, please subscribe to the channel, drop a like, and let me know if you guys want me to make any specific videos moving forward here. All right, question number 1 here. Remember our order of operations here. Let's check what type of market structure are we in. And then after determining that, can we identify where there are bearish imbalances or bullish imbalances in discount of the range? So it is very important to identify the range. I'll give you guys a few seconds, and if you want to pause the video now to try and figure that out, do so. But if not, here is the answer. The answer to question number 1 is short. Now let's take a look. We'll notice that we took out this low with this price run. Now let's see, can we identify any bearish imbalances? Well, we have a bearish imbalance up here, this one in the form of a bearish fair value gap, but we also have one right at 50% of the range, right here, right? And you'll notice that while still respecting this level, we did wick up multiple times just to get into discount of the range, and from there, you notice that we melt down quite a bit following that. So that is the answer to question number 1. The answer is short. If you have any questions about this one, feel free to drop a comment below and I can explain it. All right, here's question number 2. Take a look. What type of market structure or trend are we currently in? And from there, identify if we have any imbalances in discount of the range. So if we're in a bullish trend or bullish market structure, we're going to want price to retrace down below 50%. And if we're in a bearish trend, we're going to want price to retrace up above 50%. So if you want to pause the video, right now is the time to do it. But if not, here is answer number 2. And this was from Netflix 30-minute chart this week. You'll notice we took out swing low here, which gives us a bearish market structure. Price then sets a range. We get that retracement back where? Into discount. So above 50% of a bearish trend or bearish market structure would be discount. And specifically, we have multiple bearish imbalances right here. Also lines up well with our little golden pocket, 62 to 79% retracement levels. And from there, we dump. So this move, let's just say you bought it off of, the 70% retracement. So 479.64, your stop loss is at 481.80. That gives you $2 of risk for a potential of 474.48, which would be about a 5-point gain. So risking 2 to make at least 5. And you'll notice that here we actually formed another imbalance, and we got up into it and rejected yet again. So when you get an imbalance through your target area, I personally like to drag my stops and profit down and not just take the win right here, just to see if I could squeak out some more. Because if I can do that, or if I'm just to take my profit right away, there's going to be times where we get that breakout lower and I'm going to be annoyed about it because, I just took my profit there. So I would prefer to, especially when you see that imbalance lower, I'd slide my stop right to, right above where that imbalance formed. So it would be like right here off this candle. And, am I potentially giving back a couple bucks in profit? Yes, but I'm also allowing myself a little more so that if this thing were to break out lower, which in this case it did, I wouldn't get stopped out there and I'd make even more money on it. So yeah, this is example number 2. If you have any questions about it, feel free to, put a comment or a question down below. Here is question number 3, order of operations. Typically, the first one is going to be identifying higher time frame liquidity, so swing highs and lows on the higher time frame. I take that aspect of it out of it for now. At some point in these long short quizzes, I will have those types of examples, but for now we're just reading price based on how it's portrayed, and I've taken the little bit more difficult part out of it. So we're just reading price, nothing more, nothing less. And so for you, really your first step would be identifying what would be your market structure or trend. So if you haven't done that, you could pause the video here, but if you already got it down, here is the answer. And this was on E-mini S&P 30-minute time frame. We swept our high right here, creating a bullish market structure or trend. You'll notice that, why don't you have your high fib right here? Well, look, on this move down here, we didn't get into discount. So to me, the range is not set yet. So I'm going to wait for that range to set, which seemingly it does here. What would be the, the market tipping itself and showing me that this is actually the trend being set? Well, you have an imbalance down right here. Boom. Right? So when you see that imbalance down, to me, that's when I say, okay, this range seems to be set. If we get a retracement into that bearish imbalance, I might even look to play it down into discount for a scalp. But we notice price retraces back down to 50%. Is there a bullish imbalance? Absolutely, right here. We also have a bullish order block right here, but here's your retracement down into discount, and there it is, takes off. So from this move, 45.63 would be, or that's actually your low at the 62%, but let's just say 50%, that's where you were targeting. So 45.67 up to, our real target would be here at 45.84. What is that? 17 points. 17 points on an ES contract is a pretty good win right there. And you'll also notice, what did we do through buy side liquidity? So liquidity that's up here, or our target, we made an imbalance right here. So this would be another example where, rather than immediately take my profit upon sweeping this high, I'll wait for it and see if it's going to show me that this is going to form. Then I'm absolutely going to hold and look for higher prices. And I'm sure we can justify this move. If we were to go left, we would see that there's either some sort of imbalance or more liquidity up here that we've swept. So this is the answer to number 3. If you got any questions about it, feel free to drop a comment below. All right, this one's a little more difficult, but this is question number 4. If you're looking at this from a wider range, I guess you could say, that's when it would become more difficult. But what we have on the screen really isn't all that bad. Also drives me nuts when, I post these and people are like, oh, I need more information, or I need a time frame. I always just scratch my head on that. Really, the time frame is irrelevant in this, especially because I'm telling you right now that these are not examples where the higher time frame liquidity is going to play a role, because I'm vetting them prior to putting them on Twitter. So, and then the need more information. I would argue that I do this every week. I've been doing this every week for about 5 months now. You absolutely do not need more information. So here is the answer. If you haven't paused already, do so right now. But here is the answer to number 4, and we're looking at Baba's 30-minute chart right here. You'll notice we swept the high right here, creating a bullish market structure. Okay, price then retraces lower into our discount right here. Boom, bullish imbalance right here. Boom, and there is your run from 77 up through 78. Risk reward not great on this. Really, you're stopping at 76, so you're risking like 90 cents for a potential $1.50. So it's really not all that great. But the reason why I would have something like this, or I would even consider something like this, is because after making this imbalance down through, because this is absolutely a bearish imbalance, look left. You'll notice that we do not take out these lows. I know I'm cutting it off. But even this low that I have right here, we did not take that out. So the market structure is still bullish. So the fact that price gets down into discount of this, then takes that low one more time, that's the concept of turtle soup. Take that liquidity and then run higher, shifting market structure and also balancing this price range right here. That's pretty bullish. That's like double the layer of confluence on that. So, and you'll notice that, look at this, where the inverse is, right? So we had a previously bearish imbalance right here, inside what was our bullish imbalance, and look where the wick goes to. Can't tell me it's made up, it's too perfect. So that's the example for number 4. If you have any comments on that, definitely drop one below. All right, last but not least, our 5th and final example. Take a look. What type of market structure do we have here? Remember, I have, obviously I'm not going to put the entire chart on here, but if the fact that I'm crunching it in this way, you got to trust me, but trust that I'm giving you the real example here. And we always want to look towards the more recent price run, because the tides do turn on this one, as you'll notice here. So if you haven't paused the video, you could do so now and try to come to the conclusion. But if you've done so already, here's the answer. This is Disney on the 30-minute chart. You will notice that we sweep the swing high right here, creating a bullish market structure. Price then runs higher, takes it out, retraces lower, gets down into discount, okay? And even our low wick, we come on down here to 79%, holding on to this imbalance right here, and we take off, boom. So you might say, okay, well, Mando, look, you have this bearish imbalance right here. That doesn't freak you out at all. Well, it could, but the reason why it doesn't is because there was no higher time frame liquidity swept on this particular example. So the fact that we haven't swept any higher time frame liquidity, and if we were to look at a daily or a weekly chart, we would notice that we actually have an upside objective that we have yet to reach, and that is why your bearish PD arrays or setups aren't going to play out as well on a bullish chart. So we obviously get down into discount. Here's our imbalance here. We have one more for good measure here. This would be a volume imbalance. This would be a fair value gap. So price gets into it, takes off, takes out the high. And here's an example of where, rather than me taking or getting my profit taken immediately at the swing high at 95.58, I would say, okay, look, we are forming an imbalance here. I'm going to slide my stop loss up and see, right? And I would move it to that previous point that we initially shifted on right here. And the fact that we did move through it, what am I really losing out on? 20 cents for potential run higher. I'm cool with that. And this is a twofer. I mean, if you were to draw your range from here to there, we swept that high with this low to this high. Look at the retracement. I'd bet you that this is right around discount, maybe even the 62, but 50%, and takes off again. So these are this week's examples. I hope you learned something from this. Again, if you like this video, please press that button, subscribe to the channel. And if you want, you're looking for a place where traders trade like this, you can take a look in my bio. You'll see my group, Galaxy Trading. That's where we get after it, and we do live calls to kind of get more in depth on this stuff. So all right, well, have a good rest of the weekend, and I'll catch you guys later.